Good morning, students. Welcome you all once again on the virtual coaching classes organized by Board of Studies of ICAI. So, students, after Ind AS 115, I'm again here to teach you Ind AS 16, Property, Plant and Equipment. Students, this is the asset-based standard, and I can tell you this is the most important asset-based standard. And if you understand this particular standard, in that case, other standards, understanding for other standards would be easy if you have a better understanding for this particular standard. So what is meant by property, plant and equipment? And before just jumping into this particular standard, let us understand how many standards are available in India which talks about property, plant and equipment. So first of all, we'll talk about our old accounting standard, right? So if I talk about old accounting standard, we have AS 10. And the title of the AS 10 is again property, plant and equipment, right? Property, plant and equipment. Probably the students who have cleared IPCC or CA Inter prior to 2017, so they must have heard about that the title of AS 10 was accounting for fixed assets, right? But effective 1st April 2016, the title of AS 10 was changed, the standard was amended, and now it is property, plant and equipment. So this is under accounting standard. So this accounting standard is not applicable in your financial reporting curriculum. In financial reporting curriculum, only Ind AS are applicable. If I talk about Ind AS, so of course we have Ind AS 16, which is the agenda of the day. And Ind AS 16 again talks about property, plant and equipment, right? And you are aware that our Indian accounting standards are the converged version of IFRS applicable to India. So what are the IFRS? IFRS are the global standard. So if I talk about globally, for example, you guys have also taken GFRS paper, elective paper, right? So in GFRS, this will be IAS 16. This will be IAS 16. And again, the name is property, plant and equipment, right? Property, plant and equipment. So students, globally IAS 16 is there. In India, Ind AS 16 is there and accounting standard 10 is there. The company on which Ind AS is applicable, of course, Ind AS 16 is the standard which talks about property, plant and equipment. And what is our agenda? Our agenda is to discuss Ind AS 16 today. I hope my voice is visible properly and clear and loud. I hope the screen is also visible. Yeah. Good morning, Srinidhi. Good morning, Karush. Okay. So guys, let me talk about further. Sir, what is the importance of this particular standard? If I talk about property, plant and equipment. So property, plant and equipment is something which is very critical and very important from the examination perspective as far as weightage is concerned, as well as from the real life perspective. This is something which you will see in every balance sheet. A balance sheet of Panwala, I mean to say a very small shop, to a balance sheet of Reliance Industries Limited, you will find property, plant and equipment. What is meant by property, plant and equipment? So property, plant and equipment is like a fixed assets. It's like a tangible assets, right? So you would have multiple assets. You will read, when you read the asset-based standard, you will have multiple assets on multiple assets like inventories. Okay, so there is a separate standard on inventories. Asset could be your tangible asset where you will read in AS 16. It could be intangible assets where you will read in AS 38. There could be a biological assets under agriculture standard. There could be an investment property. There could be a non-current asset held for sale, right? There could be an investment property under Ind AS 40. So there could be a multiple assets. Now we need to understand what is meant by property, plant and equipment. When I say property, of course, the standard talks about land and building as well. When I say plant, this standard talks about something which is important or which is required for manufacture of goods and services. And when I say equipment, so when I say equipment, it could be your office equipment, it could be like laptop, it could be computers, right? So what could be the example of property, plant and equipment? The example of property, plant and equipment could be your land, building, your vehicles, aircraft, helicopters, right? refrigerator, right? Electrical installation, furniture and fixtures, right? Your tea and coffee vending machine if it has been purchased, right? Your factory, your machinery, trucks for the transportation of goods and services, okay? Fire extinguisher, which is for the safety equipment. So these could be the property, plant and equipment. And being a CA final student, we are well versed with the concept of property, plant and equipment, right? Now, friends, let's discuss what is the agenda of Ind AS 16. And let me tell you, if I talk about this standard is very critical and very important. And before jumping into this standard, let me show you the balance sheet of Reliance Industries Limited first, okay? Then I'll move on. If you see the balance sheet of Reliance Industries Limited, I hope the balance sheet is on the screen and you're able to see this balance sheet. Yeah. If you see this particular consolidated balance sheet of Reliance Industries Limited, guys, in the balance sheet, if you see the property, plant and equipment, the property, plant and equipment is worth rupees 4,51,066 crore. So 4.5 lakh crore pertains to your property, plant and equipment. And you can see that this could be the largest line item on the asset side, right? This is the largest line item on the asset side. The total asset side of Reliance Industries Limited consolidated balance sheet is 13 lakh crore. And out of 13 lakh crore, 4.5 lakh crore belongs to your property, plant and equipment, right? Let's see the schedule of this property, plant and equipment. What is there in the property, plant and equipment of Reliance Industries Limited? Let me go to the schedule of property, plant and equipment. Just wait a minute. Just give me a minute. I'm just taking out that schedule of Reliance Industries Limited, and it was schedule number 1. Okay. Yeah. So if you see the schedule of Reliance Industries Limited, which is on the screen, property, plant and equipment, right? And if you see the schedule of property, plant and equipment, you will have land, you will have building, plant and machinery, electrical installations, equipments, furniture and fixtures, vehicles, ships, aircrafts and helicopters. So these are the examples of property, plant and equipment. These are the real life example of property, plant and equipment. And out of this entire property, plant and equipment, the major line item is plant and machinery, right? If I talk about land and building, it is my property. If I talk about plant and machinery, it is my plant. If I talk about all these items, it could be covered under your plant or and equipment, right? So Ind AS 16 covers property, plant and equipment. And this is the real life example of Reliance Industries Limited, guys. I hope it is clear to everyone, property, plant and equipment. Yeah. Yes. So now coming to the agenda of this particular standard, sir, what is the agenda of this particular standard? Coming to the agenda of this particular standard, of course, like every standard, we'll talk about objective. What is the objective of this standard? Then we'll talk about scope. What is covered under this standard? Of course, it is a theoretical part. And after objective and scope, we will discuss recognition. Okay. When I say recognition, we'll talk about initial cost and we'll talk about subsequent cost. For example, today I have purchased a car, right? And today is, let's say, 12th March. So if I have purchased a car today, okay, so what is the initial cost for purchasing a car, right? At what value? So what is the initial cost of purchasing a car, and whether that car has to be recognized initially as a property, plant and equipment. When I talk about subsequent cost, of course, if after 2 years I'll do some major expenditure on my car, whether those expenditure will be recognized as a property, plant and equipment, or whether it has to be recognized into the profit and loss account. Measurement at recognition. Okay, so if I talk about measurement at recognition, so it talks about what could be the cost which is covered under measurement of cost, under measurement at initial recognition. For example, if today I have purchased a car, whether I need to capitalize this car only at a price which I have paid to the buyer, or for example, it took around, let's say, if I have paid for something like registration fee, if I have paid, let's say, some carriage inward or freight and transportation charges, so do those charges also included in the value of the car? So this standard talks about the measurement at recognition also. When I say measurement at recognition, I mean to say measurement at initial recognition. When you are recognizing the property, plant and equipment initially, then what will be the cost, right? So first we'll talk about recognition, whether that item has to be recognized at PPE or it has to be expensed off. Second, we'll talk about, okay, this item has to be recognized as a property, plant and equipment, then at what value it is going to be recognized. We'll talk about what are the allowable cost which comes under the purview of capitalization, and what are the costs which does not comes under the purview of capitalization. So we'll talk about the measurement part also. Then we'll talk about measurement after recognition. It means that once an asset has been recognized in the books of the company, an asset has been recognized in the balance sheet, then what happens after that? For example, you have purchased an asset on 12th March. So what you will do on 31st March? On 31st March, of course, you will charge depreciation. You will do the impairment testing, right? So as far as measurement after recognition is concerned, we'll talk about what are the different models for subsequent measurement. So it is a cost model and revaluation model. We'll talk about cost model. We'll talk about revaluation model. These are the same model which we have discussed under AS 10. Then we'll talk about depreciation. Then we'll talk about depreciable amount and depreciation period. We'll talk about depreciation method. We'll talk about impairment. We'll talk about compensation for impairment. And after that, we will talk about derecognition. So see the entire life cycle of a fixed asset, right? So first we have talked about the recognition, whether this asset has to be recognized as an asset, whether this item has to be recognized as a PPE. Then we have talked about if it has to be recognized as a PPE, then at what value? I'm talking about measurement. Okay. So you have identified the value and you have capitalized the property, plant and equipment. Then once it has been capitalized, then what next? What next means what at the reporting date. So initial recognition and measurement means at the transaction date. Subsequent recognition and measurement means after the transaction date, okay, or at the reporting date, right? So then derecognition. Derecognition means when the property, plant and equipment has been discarded, sold off, disposed of, then what will be the accounting treatment of this at the time of derecognition. And of course, the last theoretical concept is disclosure. We'll talk about disclosure as well, right? I hope this agenda is clear to everyone, guys. I appreciate your confirmation. Yeah, thanks, Tarush, for the confirmation. So let's discuss one by one. Coming to the objective, what is the objective of Ind AS 16? Ind AS 16 prescribe the accounting treatment for property, plant and equipment. So this standard talks about what is the accounting treatment for property, plant and equipment, right? This standard also talks about recognition of the assets, right? So when an item has to be recognized as an asset, for example, if a company has purchased a truck, whether the truck has to be recognized as a property, plant and equipment, I mean to say asset, or this truck has to be recognized as an expense, right? Determination of the carrying amount. Okay, so what is meant by carrying amount? Carrying amount means an amount at which the asset is carried in the balance sheet. The asset is carried in the balance sheet. Okay, so carrying amount means cost minus accumulated depreciation minus accumulated impairment. So this standard helps you in determination of carrying amount, that what is my original cost, how this depreciation has to be calculated, then impairment needs to be deducted, and then you will arrive at a carrying amount. This standard also covers the concept of depreciation charges. What is depreciation? How this depreciation is calculated? How this depreciation method is to be identified? So this standard also talks about depreciation concepts. And the last one, this standard also touch upon the impairment losses concept, although this standard does not prescribe the detailed concept of impairment losses, because there is a separate standard in AS 36 which talks about impairment losses. But yes, this standard also touches the concept of impairment losses, right? This is the objective of this particular standard. Okay. Coming to the scope, now we are going to discuss, sir, this standard is applicable where? This standard is applicable on which items? So coming to this scope part, the scope part talks about where the standard is applicable or where the standard is not applicable. So it says that Ind AS 16 is applicable to all kinds of property, plant and equipment, all kinds, right? So it says that wherever PP is there, all kinds of PPE is there, this standard will be applicable, except but a negative list is given. Okay, so this standard is applicable to every property, plant and equipment, except what is the negative list? Property, plant and equipment classified as held for sale, right? So friends, under Ind AS 105, there is a separate standard which talks about PPE, which talks about held for sale. Okay, when you read Ind AS 105, this is a standard which talks about non-current asset held for sale and discontinued operations, right? So first of all, you need to understand Maruti. So what is Maruti? Maruti Suzuki India Limited is an automobile company. Maruti Suzuki, what is the business model of Maruti? So Maruti manufacture cars and sells cars, right? Whether car is a fixed asset for Maruti, whether car is a property, plant and equipment for Maruti, answer is no. Car is a inventory for Maruti, right? If I talk about Infosys Limited, Infosys is the IT company, right? So if Infosys purchases car from Maruti, so whether this car in the books of Infosys is inventory or property, plant and equipment, whether this car in the books of Infosys is inventory or property, plant and equipment. So in the books of Maruti, these cars are inventory. So we are all understood, because car is inventory for Maruti. But what about Infosys if Infosys purchases car from Maruti? Yes, Tarush, you're right. It is a property, plant and equipment. It is not inventory, because Infosys does not deals in manufacturing and selling of cars, right? So it is a property, plant and equipment. So when you read in AS 105, it says that if there is a non-current asset, for example, property, plant and equipment, and if that property, plant and equipment is held for sale, so Infosys has a car, Infosys has a building, and these are the property, plant and equipment. If Infosys wants to sell this car, or if the Infosys wants to sell its building, so in that case, it will be classified as held for sale. Okay, so some condition and criteria are given in Ind AS 105, but the crux of the story is, if a property, plant and equipment, not inventory, if a property, plant and equipment, which is a non-current asset, is classified as held for sale, then it will not cover under Ind AS 16. It will cover under Ind AS 105. Okay, right? Yeah. Second, biological asset related to agricultural activity. So biological asset related to agricultural activity comes under the purview of Ind AS 41. Okay, Ind AS 41, and hence it is coming under the purview of Ind AS 41, and hence it is not covered under Ind AS 16, because there is a specific standard which talks about biological asset related to agricultural activity. So guys, what is meant by biological asset? Biological asset is living animal or plant. Living animal or plant. Okay, so when you read Ind AS 41, you will find this definition. Biological asset means living animal or plant, right? If such living animal or plant is related to agricultural activity, then it will be covered under Ind AS 41. It will not be covered under Ind AS 16. But there is an exception. And what is the exception? except bearer plants. Except bearer plant. So this is a new concept under Ind AS. Bearer plant. What is meant by bearer plant? Bearer plant are those plants which produces agricultural produce. For example, mango tree. So mango tree is a bearer plant which produces agricultural produce. What is the agricultural produce for mango tree? Mangoes. So mangoes, right? So for a mango tree is a bearer plant which produces mangoes for more than 1 year, for more than one period, right? If you plant a mango plant or mango tree, so of course you will not have a mangoes only for 1 year. You will have mangoes for 20 years, 30 years, 15 years, right? So bearer plant means those plants which bear the produce. Okay, for example, tea plant, coffee plant, coconut plant, okay, apple plant or apple tree, mango tree. So these kind of plants, these kind of trees provides fruits, okay, for more than 1 year, more than one period. So such plants are called as a bearer plant. Okay, so these bearer plant comes into the purview of Ind AS 16, not Ind AS 14, right? So apart from bearer plant, all the plants, if it is related to agricultural activity, covered under Ind AS 41. So guys, only bearer plant comes under the purview of Ind AS 16, right? And what is meant by, sir, biological asset related to agricultural activity? So what is meant by biological asset? Living animal or plant. For plant, we have discussed if it is bearer plant, I mean to say if the agricultural produce, if the fruits are produced by that plant or that tree for more than 1 year, it is known as a bearer plant, and bearer plant comes under the purview of Ind AS 16. Sir, what about animals? If the animals are related to agricultural activity, okay, for example, like cows. If cows are used for plowing the fields, okay, cows are used for the agricultural purposes, then those cows are also covered under Ind AS 41, not Ind AS 16. But sir, if the cow are used for the transportation of goods and services, then if the cows are used for transportation of goods and services, horses are used for transportation of goods and services, then it will be covered under Ind AS 16 property, plant and equipment. Why? Because it is not related to agricultural activity. Have you heard about a circus company, Cirque du Soleil? Have you heard about that? Cirque du Soleil? Yeah. So there is a circus company, Cirque du Soleil, right? And if you see the circus, so in circus, they are using some animals, right? Like monkey is riding the bicycle, okay? Like the tiger or let's say lion is jumping in the wings of fire, right? In the ring of fire, okay? So if I talk about these kind of animals, if these kind of animals are used for circus, used to entertain the audience, then this is a commercial activity. This is not an agricultural activity, right? So if such animals are purchased by these circus company to entertain the audience, okay, in that case, such kind of animals are covered under Ind AS 16, not under Ind AS 41. Clear? Arush is asking, sir, whether tractor is covered under Ind AS 16 or Ind AS 41. Tarush, whether tractor is animal or plant. Tractor is neither an animal nor a plant. So tractor is covered under Ind AS 16, right? Tractor is not covered under Ind AS 41. It only talks about biological asset related to agricultural activity, right? And we have given an exception like bearer plant, the plant which produces I mean to say fruits for more than 1 year, is those kind of plants are covered under Ind AS 16. Or animals which are used for other than agricultural activity, for example, transportation of goods and services, for example, circus, right? So these kind of animals are used for are covered under Ind AS 16. Third, recognition and measurement of exploration and evaluation assets, mineral rights and mineral reserves such as oil, natural gas, and similar non-regenerative resources. So these are also not covered under Ind AS 16. Why? Because these are covered under Ind AS 106, right? So recognition and measurement of exploration and evaluation assets. Okay. Mineral rights and mineral reserves such as oil, natural gas, and similar non-regenerative resources. The standard will be applicable to property, plant, and equipment which are used to develop or maintain the above assets. So guys, although on these items Ind AS 16 will not be applicable, but for example, there is a mining. Okay. So a crane is used for just digging the mining ores, right? So these mining ores are not covered under Ind AS 16, but the crane which is used to digging or excavating the mines for extracting the mining ores, right? So this crane, this machinery, okay, this machinery, this crane, this kind of machines are covered under Ind AS 16. Okay. So although PP is not classified as held for sale, not covered under Ind AS 16. Biological assets related to agricultural activity is not covered under Ind AS 16. Recognition and measurement of exploration and evaluation asset, mineral rights, mineral reserves such as oil, natural gas, and similar non-regenerative resources are also not covered under Ind AS 16 because it is covered under Ind AS 106. But if the assets, if the PP is used to develop or maintain such kind of asset, then Ind AS 16 will be applicable on those items, right? Clear? Srinidhi is asking, sir, when cows are used for both agriculture and transportation by farmer, then what is the applicability, sir? Srinidhi, for example, the farmer are using cows for agricultural activity, and also they are using the same cow for, let's say, taking their agriculture produce to the market, right? So in that case, they are just using this cow for both the alternative purposes. So in this case, it has to be covered under Ind AS 41 because the primary use is, of course, plowing the field. Once the items are produced, once the agriculture produce are there, then only they are just taking that to the market. Okay. So they are not using that cows, for example, for earning money in terms of, in terms of doing this transportation activity. So primary activity of the farmer is not to be engaged in the transportation activity, right? So it is not the commercial activity of the farmer. They are just using that cows for the purpose of taking those goods to the market or to other areas. Of course, it has to be covered under Ind AS 41, right? Agriculture. But if only their purpose is to take these cows for the transportation purpose only, then it will be Ind AS 16, not for the agricultural activity, but for the transportation purposes, right? Then it has to be covered under Ind AS 16. So when you read agricultural activity under Ind AS 41, you will find that what is meant by agricultural activity, right? I hope it is clear, Srinidhi. So coming to the definition of PP, and guys, definition of PP is very, very important, right? So let me move you guys on the Excel file, and I hope my Excel file is visible to everyone. Yeah. So friends, we have discussed the objective part of the standard. We have discussed that. Okay. We have discussed the scope part of the standard. Okay. We have discussed the scope part of the standard, right? Now it is important to understand, sir, what is meant by PPE. What is the definition of property, plant, and equipment? What is the definition of property, plant, and equipment, right? PPE, definition of property, plant, and equipment. I'll call it as a PPE, right? PPE. So what is meant by PPE? Property, plant, and equipment are tangible items. Tangible items. Okay. So property, plant, and equipment are tangible items. Tangible items which are held for. Tangible items which are held for. Which are held for what? Held for what? Tangible items which are held for. Held for use in the production or supply of goods and services, production or supply of goods and services held for use in the production or supply of goods and services, or or for rental purposes, or for rental purposes, or for administrative purposes, right? So held for use in the production or supply of goods and services, held for use in the production, held for use in the production or supply of goods and services, right? Production or supply of goods and services, or for rental purposes, or for administrative purposes, right? Or for administrative purposes. If the tangible items are used for production or supply of goods and services, or for rental purposes, or for administrative purposes, and what? And expected to be used for more than one period, and expected to be used for more than one period. Let's discuss this one by one. First of all, tangible item. What is meant by tangible item? What is meant by tangible item? Friends, what is meant by tangible item? So tangible item means the item which you can see, which you can touch, which you can feel, right? For example, a building is a tangible item. Machinery is a tangible item. Vehicle is a tangible item. Refrigerator is a tangible item. Laptop and computers are tangible items. Software. Can you see the software? You can feel the software that yes, it is functioning. You cannot see the software. So software is not a tangible item. It is intangible item. Brand, copyright, trademark, intellectual property right, goodwill. Is it a tangible item? This is intangible item, right? So first of all, to be covered under the definition of PPE, it should be a tangible item, right? Tangible item held for use in the production or supply of goods and services. Production or supply of goods and services. Machinery. What is the use of the machinery? Machinery is used for production of goods, right? What is the use of trucks? Trucks are used for supply of goods, right? So this machine and truck are tangible item which is held for use in the production or supply of goods and services, right? Have you heard about Blue Dart? Have you heard of Blue Dart? Courier services, Blue Dart, right? So if you see the balance sheet of Blue Dart, they have some aircrafts also. And what is the objective of those aircrafts? The objective of those aircraft is to carry these, is to carry the goods, right? Is to carry the parcels, delivery parcels from one place to another, right? So these are just like a cargo. These are just like a cargo crafts, right? So what is the objective of this aircraft? These aircrafts are tangible item which is used as a cargo craft, right? For taking a parcel from one place to another, right? So if a tangible item is held for use either in the production or supply of goods and services, it is a property, plant and equipment, provided it has to be used. It is expected to be used for more than one period, and which is generally considered as more than 1 year. Which is generally considered as more than 1 year, right? When I say one period, generally it is more than 1 year, right? Sir, what next? Tangible item which is held for use in production or supply of goods and services, or for rental purposes, Have you seen the construction sites? Have you seen the construction sites? When you went to the construction sites, you will find some equipment like crane, like lorries, okay? Like there is a machinery which is used for the which is used for mixing the material, which is used for the construction, right? So you will find a lot of equipment, lot of heavy equipment in the construction sites. Generally, these contractor, these construction company took these equipments on a higher basis, on a rental basis, right? So the companies which are giving these equipments to the customers on a rental purposes, for the rental purposes. For example, I am a company which is which provides these kind of cranes, these kind of mixing machines, okay, to the real estate contractors on a rental basis. So in that case, in my balance sheet, these kind of cranes, these kind of machineries are property, plant and equipment. Of course, its life is more than 1 year. Its expected usage is more than 1 year, right? But my dear friends, when I am talking about rental purposes, there is an exception to it. There is an exception to it. What is the exception? Please write down. What is the exception? If land and building is held for rental purposes, then it is not PPE. It will be covered as investment property under Ind AS 40. Please write down, this is an exception. When you read the next asset-based standard, you will find that there is a standard Ind AS 40 investment property. And investment property, what is investment property? A land and building, two specific assets are there. A land and building which is held for capital appreciation or held for rental purposes, then it will be covered under investment property. Then it is an investment property to be covered under Ind AS 40. It is not Ind AS 16 PPE. So except land and building, whatever is provided on a rental basis, then it will be covered under PPE. So one more example I'll take here. You guys must have attended the marriage of your relative, or let's say your friends, okay? Or you guys have heard about, in the marriage, normally just to show off or just to enjoy the marriage, okay, or just to make it expensive, normally people used to use Mercedes, BMW, Audi for just taking their barat, or just taking their just used in the marriage events, right? So there are companies who are providing these luxury cars on a rental basis, right? These luxury car on rental basis. So these companies who are providing these luxury cars on rental basis, these cars are not investment property. These cars are property, plant and equipment for these companies, right? For Blue Dart, sorry, not the example of Blue Dart, for the companies which are providing crane on rental basis, these cranes are Ind AS 16 property, plant and equipment. These cranes are property, plant and equipment for those companies. Companies are providing tractor on a rental basis to the farmers, right? To the contractors for plowing the fields, right? So for these companies who are owning tractors, which is held for the rental purposes, so these tractors are also property, plant and equipment in the books of the tractor owners, okay? So the only exception is for land and building. If such land and building is held for rental purposes, then it is not covered under Ind AS 16. It will be covered under Ind AS 40, which is a specific standard on investment property, right? I hope you guys have understood this part. Yeah, any doubt, any queries so far? Yeah, yes, Tarush, only this exception is for land and building. If land and building is held for rental purposes, then it is not property, plant and equipment, it is investment property. For all the items other than land and building, if the company is holding for rental purposes, it is property, plant and equipment, right? Yeah, or for administrative purposes. What is meant by administrative purposes? Yeah, for example, furniture and fixtures. For example, office equipment. So neither these items the company is used in production or supply of goods and services, neither for rental purposes. But of course, if I would not have furniture and fixtures, how can I teach you, right? So I need chair to sit for 8 hours or 9 hours in a day to perform my duties, right? So these furniture and fixtures are held for the administrative purposes, not for production or supply of goods and services, not for the rental purposes, but of course it is for the administrative purposes. So the asset which is used for administrative purposes is again a property, plant and equipment, provided its life should be for more than 1 year, right? It is expected to be used for more than 1 year. Sir, I have purchased a machinery and the life of the machinery is 2 months. And yes, I'll use this in the production of goods and services. Sir, whether it is PPE, guys, it is not PPE, right? Why? The life is less than 1 year. Okay. So I hope you guys have understood what is the definition of PPE. Property, plant and equipment are tangible item which is held for use in production or supply of goods and services, or for rental purposes or for administrative purposes, and which is expected to be used for more than 1 year. Okay. What is the exception? The exception is if the life is less than 1 year, then it is not PPE. If the land and building is held for rental purposes, it is not PPE, then it is investment property, right? I hope it is clear to everyone. So friends, we have covered the definition of property, plant and equipment, right? Now let's discuss this case study one. XYZ Limited has acquired a land to construct a plant, to construct a factory for manufacturing of goods, right? So it has acquired a land to construct a factory for manufacturing of goods. Also acquired below items for the business. Machine A for production, building for rental purposes, truck for transportation of goods, furniture and fixture for office administration, laptop for the employees for office working, SAP software for maintaining records and books of accounts. Identify whether above items are PPE or not. Identify whether above items are property, plant and equipment or not, right? So friends, first of all, tell me whether land is PPE. Tell me whether land is PPE. What is the objective of land? To construct a factory, right? Not for the purpose of rental purposes. So in that case, yes. Whether land is a tangible item, yes, sir. Whether land is held for use, whether land is held for use in the production or supply of goods and services, whether the life is more than 1 year, answer is yes, right? So land is a property, plant and equipment. Machine A for production, whether machine is a property, plant and equipment, whether machine is a property, plant and equipment. Yeah, yes, machine A is a tangible item, tangible asset held for production of goods. And of course, if life is 1 year or more than 1 year, then it is a property, plant and equipment. Building for rental purposes, guys, building for rental purposes, is it a PPE? Whether building for rental purposes is a PPE. Land and building held for rental purposes is not PPE. It is investment property. It is IP, investment property, right? Truck for transportation of goods, is it a PPE? Truck for transportation of goods, is it a PPE? Yeah. Truck for transportation of goods is a PPE. Yes, it is property, plant and equipment, right? The tangible item is held for supply of services, supply of goods and services, right? Furniture and fixtures for office administration, is it a tangible item? Yes. Life is 1 year or more, answer is, let's say, yes. Held for administrative purposes, is it PPE? Yes, it is PPE. Laptop for the employees for office working, yeah. So laptop for the employees for office working, of course these are for administrative purposes, these are for the services, right? So whether laptop or PPE, guys, can you answer quickly? Nushri, Sunidhi, Sairam, Yeah, Priya. Yes, laptop is PPE. SAP software for maintaining records and books of accounts. Software. It is not a tangible asset. It is intangible asset. It is not PPE. No, not PPE. It is intangible asset. It is IA, intangible asset. Okay. So we have understood these things. What is PPE? What is not PPE? Land is a PPE. Plant is a PPE. Machine is a PPE. Building is an investment property. It is not PPE. Truck, goods for transportation purpose PPE. Furniture and fixture is PPE. Laptops are PPE. SAP software are not PPE. It is intangible asset. So building will be covered under Ind AS 40. SAP software will be covered under Ind AS 38. Right. I hope it is clear to everyone. Yeah, you are right, Priya. Yes. Sairam is asking, sir, if I have purchased a truck for giving in the rent, then what will be the treatment? Sairam, it is a PPE. Okay. If a company is purchasing a vehicle for giving it on the rental basis, it is a property, plant and equipment. So what I'm trying to say, you need to see the purpose. Is it a tangible item? Truck is a tangible item. Whether this tangible item is held for use in production of goods, answer is no. Whether the tangible item is held for supply of goods and services, answer is no. Whether it is held for rental purposes, answer is yes. So such item is property, plant and equipment, right? Or is it held for administrative purposes? For example, answer is yes. So then it is property, plant and equipment, right? I hope it is clear to everyone, guys. I can see a lot of participation now. Yeah. So friends, we have discussed the definition of PPE. Now we are going to discuss recognition criteria. When I say recognition criteria, so far we have understood, sir, what is the definition of property, plant and equipment we have understood, right? Now, whether that property, plant and equipment, for example, if an item is meeting the definition of PPE, should we recognize this item in the books of accounts as a property, plant and equipment, or we should recognize this item as other assets, or we have to charge off this item in the profit and loss account, right? Right. So we have understood three leg tangible items should be there, held for use in production or supply of goods and services should be there, right? And expected to be used for more than 1 year should be there, right? So this is there. Okay. Yeah. But if it is expected to be used for more than 1 year, then it is coming under the definition of PPE, right? Sir, if a machine has a life of 4 months, is it a PPE? Answer is it is not meeting the definition of PPE, right? Now coming to recognition criteria, when an item has to be recognized as a property, plant and equipment, when an item has to be recognized as a property, plant and equipment and has to be capitalized in the balance sheet, right? So let me share my Excel file once again. So recognition criteria. What is the recognition criteria for recognizing such item as a property, plant and equipment, right, in the books of accounts? Recognition criteria. When you will capitalize this item as a PPE. Okay. So first condition, recognition criteria. An item will be recognized as PPE if following two conditions are satisfied. What are the two conditions which is satisfied? Number A, future economic benefit. Future economic benefit is probable. Future economic benefit is probable, right? Cost can be measured reliably. Future economic benefit is probable and cost can be measured reliably, right? An item will be recognized as a PPE if following two conditions are satisfied. Future economic benefit is probable and cost can be measured reliably. Now I'll explain this one by one. You have purchased a car, right? The moment you have purchased a car, for example, it was a diesel car, and the government has come up with an announcement that such car will be banned in India, right? So no diesel car will be there in India. I'm just taking a hypothetical example. So friends, since you have bought a diesel car, so of course cost can be measured reliably. You are aware about the cost because you have purchased this car. Am I right? Invoice is there, you have made a payment. So of course cost can be measured reliably. You are well aware that I have purchased a Hyundai Verna car and the cost of the car is 10 lakh rupees, right? But guys, whether future economic benefit is probable out of this car? Can you enjoy the benefit out of this car? Can you use this car? Yeah. For example, the life of the car is 10 years. Can you expect the usage of this car? Can you use this car? Because government of India has banned this car the moment you have purchased this. Tell me whether future economic benefit is probable. Answer is no. Sir, of course it was a tangible item, right? Held for use in production or supply of goods and services, or let's say for administrative purposes, it was meeting that criteria. The life is more than 1 year. Expected usage is for more than 1 year. But future economic benefit is not probable. Why? Because the government has banned this car. In this case, it will not be recognized as a property, plant and equipment. It will charge off as an expense in the profit and loss account. It will be charged off as an expense in the profit and loss account, right? Second example, you have purchased a machinery from China, right? The moment the machine reaches to the factory, the government has banned the output which is produced out of that machinery, So now this machinery is of no use except to be sold as an scrap, right? This machine is not having any use. So guys, can I capitalize? Can I recognize this machinery as a property, plant and equipment in the balance sheet? Can I recognize this machinery as a property, plant and equipment in the balance sheet? Priya, what is your answer? Sairam? Srinidhi? Vidula? What is your answer? Tanushri? This machinery will not be recognized as a property, plant and equipment. Why? Because future economic benefit is not probable. Cost is measured reliably. We are aware about the cost. In most of the cases, we are aware about the cost, but we need to see whether we will be able to derive future economic benefit. If answer is yes, then we can recognize that item as a property, plant and equipment, otherwise not, right? Yes, Tarush, you are right. Clear? So future economic benefit is probable and cost can be measured reliably. If these two conditions are meeting, then that item will be recognized as a property, plant and equipment, right? Is it clear? So recognition criteria, when it is probable that future economic benefit will flow to the entity and cost can be measured reliably, that item will be recognized as a property, plant and equipment in the balance sheet. Okay, right? Spare parts, standby equipment and servicing equipment. Sir, we have purchased some spare parts. We have purchased some standby equipments. We have purchased some servicing equipment, right? Sir, what will be the treatment of these items in the balance sheet, in the books of accounts? First of all, you need to see whether it is meeting the definition of property, plant and equipment. These are tangible item, of course. These are held for use in production or supply of goods and services. Yes. Why? Because these spare parts, standby equipment and servicing equipment are, of course, for machinery, and it is used for sale, or it is used for production or supply of goods and services. For example, we have purchased a truck and we have purchased some spare part of the truck, right? So yes, it will be there. But whether it is expected to be used for more than 1 year, more than one period. For example, a company which is purchasing a car is also buying a air filter, oil filter, diesel filter, right? So what is the life of these filters? The life of these filters are 6 months, 9 months, 8 months, right? So whenever you go to the service, of course, you need to replace these kind of air filter, oil filter. Very small item, right? Greasing oil, very small item. So first you need to see whether it is meeting the definition of PPE. For example, yes, tangible item is there, held for use in production, supply of goods and services are there. But whether the life is also more than 1 year, I mean to say, whether it is expected to be used for more than 1 year. If the answer is yes, it is expected to be used for more than 1 year, yes, it is PPE, then you need to ask if it is PPE, whether the cost can be measured reliably, and of course, yes, in most of the cases, cost can be measured reliably, right? Whether the future economic benefit is probable. If the future economic benefit is probable, I mean to say recognition condition are meeting and the definition is meeting, it has to be recognized as per Ind AS 16. Otherwise, it has to be recognized as an inventory under Ind AS 2. So the small item like spare parts, standby equipment and servicing equipment are covered under Ind AS 2. But if it is meeting the recognition criteria and definition of PPE, then it can be classified as Ind AS 16 PPE, and Ind AS 16 provisions will be applicable, right? Clear? Is it clear? Okay, so there is one query. Trustee is asking, sir, what about safety equipment? Okay, like fire extinguisher. Very good question. Safety equipment. What about safety equipment? Safety equipment like fire extinguisher. Sir, is it a tangible item? Yes. Life is more than 1 year. I mean to say expected usage is more than 1 year or 1 year. Yes. Is it held for use in production or supply of goods and services? Answer is no. Is it held for rental purposes? Answer is no. Is it held for administrative purposes? Answer is no. It is held for, sometimes the safety equipment are governed by law. For example, in every theater, you will see these fire extinguisher. In every offices, you will see fire extinguisher. Okay, so that if some mishappening will happen, so there are some equipment to protect the life of the people, right? So these kind of equipments are not directly giving benefit to the business, but of course, these kind of equipments are indirectly supporting the business to continue as a business. Am I right? If there is a fire extinguisher, and for example, if there is a fire which is broke out in the premises of a company, so these fire extinguisher are used to just wipe out that fire, okay, just to control that fire, right? So these kind of equipment are only getting used when there are mishappening. So these kind of equipments are not directly providing any future economic benefit to the business, but yes, these kind of equipments are important to ensure that the business will continue as a business, right? So standard says that these kind of safety equipments are capitalized, are recognized as a property, plant and equipment under Ind AS 16. Although they are not giving their future economic benefit directly, but it is helping to arrive future economic benefit from the entire business, right? For example, if you see some acid factory, nuclear plants. So in acid plant, in nuclear plant, there are a lot of safety equipments which is governed by the law, or which is just kept for the safety purposes, right? For example, in the acid plant or a nuclear plant, there is big water hose, water tank, right? Big water tank, right? there are, big pipelines. Okay, so these all kind of water hose, pipelines, these are capitalized as a property, plant and equipment, as a safety equipment, right? I hope it is clear to everyone, guys. Sairam has asked one question. Sir, what if at the time of purchase, a machinery is used for producing goods, which is allowed by government, but after some period, government has banned the product that producing the goods from purchase, then what will the treatment and when we recognize the expense? So Sairam has asked a very good question. First of all, Sairam, we are talking about the recognition criteria. And when I say recognition, it means first time recognition, right? So Sairam, when at the time of purchase, if you were expecting the future economic benefit because the government was allowing the manufacturing of goods from that particular machinery, so of course there was a future economic benefit. So you must have recognized the fixed asset. You must have recognized the property, plant and equipment. But after some period of time, the government has banned the output from that particular machinery. So in that case, you have to dispose of, you have to de-recognize that asset and you have to charge it into the P&L. In that case, of course, the impairment provision will come into the picture, right? When the government has banned the output, so the value of the machinery has drastically go down. And of course, when I measure the recoverable value, probably the recoverable value is equal to the scrap value. It is equal to the scrap value, right? So once you have already recognized the asset, then impairment provision will comes into play. Then de-recognition provision will come into play. But what I was only talking about the recognition criteria, means first time recognition. Okay, when you have purchased, whether you have to charge it to the P&L or you have to capitalize as a property, plant and equipment. I hope, Sairam, I have given your answer. So in your scenario, at the time of recognition, this has to be capitalized as a property, plant and equipment, right? And whenever government will do this kind of announcement, of course, the impairment provision will come and the asset has to de-recognize to the extent of, and has to be de-recognized and come down to the extent of recoverable value, right? So guys, we have talked about the initial cost. I mean to say, we have talked about that at the time of initial recognition, if it is meeting the definition of PP and future economic benefit is probable and cost can be measured reliably, we have to capitalize that item as a property, plant and equipment. Okay, so we are very much clear about the initial cost. When I say initial cost, of course, if I have purchased a machinery, if I purchase a vehicle today, so I am talking about, yes, whether future economic benefit is probable, answer is yes. Whether cost can be measured reliably, answer is yes. If these two conditions are meeting, of course, I need to capitalize this asset as a property, plant and equipment, right? So as far as initial recognition is concerned, initial cost is concerned, it is pretty clear. Now coming to the subsequent cost, sir, what happens if subsequently I am incurring into a major expenditure, right? Then what happens? Sir, for example, I have purchased a truck, but after few years, I am replacing the engine of the truck. The life of the truck is 10 years, but after 5 years, the engine becomes faulty and I am getting the replacement of this engine of the truck, right? And of course, it will carry a huge cost. So my question is it a subsequent cost? Answer is yes, because this cost has been incurred after initial recognition of the property, plant and equipment, after incurring the initial cost of the property, plant and equipment, right? So guys, when you have read old accounting standard 10, you remember that what was old accounting standard 10? Old accounting standard 10 says that the subsequent cost will be capitalized only if the performance of the asset has been increased beyond the existing capacity, right? For example, when you have purchased the truck, it was, let's say, the engine was 800 cc, 800 cubic capacity. But when you have incurred a cost, this 800 cubic capacity has become 1200 cubic capacity. So the performance has increased from the existing capacity or the existing capacity have been increased. So in that case, we will only capitalize the replacement or subsequent cost or replacement expenditure, right? But under Ind AS or IFRS, even under revised accounting standard, the criteria has been changed. So for subsequent cost, what could be the subsequent cost? Major repair, major replacement, inspection cost, right? If the entity is incurring a major cost, if the entity is incurring a huge cost, right, then what will be the treatment of that cost? So standard says that same criteria followed as of initial recognition. You need to add it in the carrying amount of the PP if recognition criteria is met. Same criteria, same recognition criteria is there for initial cost as well as subsequent cost. Okay, I mean to say, you are just replacing the engine of the truck, then you need to see whether cost can be measured reliably. Answer is yes. Whether future economic benefit is probable. Answer is yes. Because if you will not replace the engine of the truck, you will not be able to use that truck, right? You will not be able to use that truck. Clear? So if you will not be able to use that truck, then you will not enjoy the future economic benefits. Is it clear, friends? So under Ind AS, under IFRS, or even under the revised accounting standard, for subsequent costs, same criteria is there, right? So what are the recognition criteria for subsequent costs? Same criteria. Probable that future economic benefit will flow and the cost can be measured reliably. Sir, normally when we go to the audit into a plant, so we have seen that there is a day-to-day servicing cost. Okay, so there is a greasing oil, there are some bearing, okay, which the entity used to regularly change on a regular basis, right? So the day-to-day servicing cost, which includes labor and consumables, needs to be expensed off. This day-to-day subsequent cost will not be capitalized. This has to be expensed off, right? What needs to be capitalized? The major cost or subsequent cost in the form of replacement cost, major inspection, overhauls. These are going to be capitalized. For example, you have just spent, you have replaced engine of the truck. Okay, then of course it is a major replacement and it has to be capitalized, right? You have just replaced tire of the truck. So the cost of the truck is, let's say, 25 lakh. The tire cost, for example, 4 tire cost, let's say 40,000 rupees. So this is 40,000 versus 25 lakh. This is not a major replacement, right? So this can be charged off as a repair and maintenance cost, right? But if you have replaced the engine, of course it will carry a huge cost like 5 lakh or 6 lakh rupees. So it is a major replacement, it is a major overhauls. So this has to be capitalized. Sir, if we will not replace tire, of course we will not be able to run the truck. So of course, when you replace the tire, future economic benefit will be there. Cost is measured reliably, right? But you need to see from the perspective of, is it a major expenditure? For example, if you in a year you are running, let's say 30,000, 40,000, and every year you're replacing the tires, right? So this is kind of a repair and maintenance expenditure. This should not be capitalized. Okay, this should not be added into the cost of the truck, right? I hope it is clear to everyone. Okay, guys. So this is in the form of replacement cost, major inspection, overhauls, right? So replacement of parts. Some items are a series of linked parts which require regular replacement at different intervals and having a different useful life. Okay. The carrying amount of an item, recognizing the cost of replacing a part when that cost is incurred. If the recognition criteria are satisfied, the carrying amount of replaced parts is derecognized. Sir, what does it mean? So guys, let me take you on my Excel file, and I hope my Excel file is visible. So recognition criteria. We were talking about recognition criteria. Recognition criteria is same for initial cost as well as subsequent cost. Please write down as well as subsequent cost. Okay. This is same as well as for initial cost as well as subsequent cost. When I say subsequent cost, So subsequent cost in the form of major replacement, overhauls, and major inspection. Inspection needs to be capitalized and added to the cost of the asset, cost of the PPE. If recognition criteria is meeting, right? If recognition criteria is meeting. Sir, if the recognition criteria is not meeting, then what to do? In that case, this subsequent cost has to be recognized as expense in the P&L, right? So day-to-day cost or small repairs are charged to P&L, right? Okay. Sir, in your example, for example, you have purchased a truck. Right? Example, the company has purchased a truck for rupees 20 lakhs. On 1st April 2015, right? Life of the truck is 10 years, right? On 1st April, let's say 2020, the company has replaced engine of the truck for rupees 5 lakhs as it become faulty and the truck was not able to run. Now the question arises, the life of the truck is 10 years, but after 5 years, this engine become faulty. So guys, tell me, when the company has purchased a truck on 1st April 2015, this truck was including engine when purchased, am I right? When you have purchased a vehicle, it was including engine was there. If engine would not have been there, you would not have been able to use the truck. You will not be able to use the truck, right? So this truck was including engine when purchased, right? So when we are incurring our major expenditure on replacement of the engine, then of course there will be 2 engine if I'll add. So what your standard says that in case of a subsequent cost, if it is a major replacement cost, it has to be added to the cost of PPE. Okay. So of course, when on 1st April 2015, when this truck was purchased, on 1st April 2015, when this truck was purchased, there was engine, and on 1st April 2020, again one engine has been purchased for replacement, and the same needs to be added to the cost of the truck. Friends, the truck was purchased for 20 lakhs. So don't you think this 20 lakh was including, when this truck was purchased for rupees 20 lakhs, so don't you think it includes engine, of course, as well as truck other than engine, right? Truck other than engine and truck other than engine, right? So friends, tell me one thing, if I will add this 5 lakh to this truck, I'm talking about the gross block. I'm talking about the gross block of the truck. So gross block of the truck. Don't you think it will become 20 lakhs plus 5 lakhs? So it will become 25 lakhs. Don't you think it will become 25 lakhs? Is it a right treatment? And if you see in this particular case, you will find that one truck will have 2 engines. One truck will have 2 engines. So do you find this treatment proper? Guys, are you getting this? So there was one truck, but there are 2 engines. So in this case, standard says that whenever there is a subsequent cost, you need to add that subsequent cost to the cost of PPE. But you are required to, it is not correct. You are required to de-recognize. You are required to de-recognize the old engine from PPE. Okay. You are required to de-recognize the old engine from PPE. Okay. So I need to de-recognize the old engine. De-recognize the old engine from PPE. Right? Is it clear? We need to de-recognize the old engine from property, plant, and equipment. Is it clear? So in that case, when we de-recognize the existing engine and capitalize the new engine, so of course, in this truck, there will only be one engine and the gross block will not be 25 lakhs. So gross block will be 20 lakhs minus cost of the original engine plus cost of the new engine, right? So this will be either less than 20 lakhs or could be more than 20 lakhs. But of course, the cost will only be a cost of single engine. Is it clear? Sir, how to de-recognize the old engine from PPE? How to de-recognize? Okay. So standard says that first, how to de-recognize the old engine? How to arrive at a value to de-recognize the old engine, right? Right? Because when you buy the car, your invoice does not carry the value of the car is this much other than engine and the value of the engine is this much, right? So you will not have a breakup of component, right? While buying a vehicle. Am I right? You don't have a breakup of the component. So standard says that first of all, if the value is identifiable at the time of purchase, then use that value for de-recognition. Second, if value is not identifiable, then use the current value. Because of course, today, I mean to say after 5 years, you are replacing this engine. So today you are aware about the cost. So then use the current value and discount it to the date of original purchase. Then discount it to the date of original purchase to arrive at the original value. For example, I bought this engine because when I bought this truck, I don't have the breakup of what is the value of the engine, what is the cost of the engine, and what is the value of the part other than engine, right? Truck other than engine. But today, when I am replacing this engine, I know that the cost is 5 lakh rupees, right? So if I discount it before 5 years, just 5 years backward, if I'll discount this, for example, the discount rate is 10%. So today I'm incurring a cost of, let's say, 5 lakh rupees, right? So what is my today cost? My today cost is 5 lakh rupees, right? Today my cost is 5 lakh rupees. Assuming the discount rate is, let's say, 10% for this company. So now I need to arrive at the cost, the present value 5 years back. Right. What will the present value? First of all, I need to calculate the present value factor. What is the present value factor? Can I write this like 1 divided by 1 plus 10%, 1 divided by 1 plus 10% to the raise 5. Okay, because I need to calculate this just present value. What was the present value 5 years ago, right? So in this case, if I talk about this, this comes out at 0.621. Okay, so what is my present value? My present value 5 years back is 5 lakh multiplied by 0.621. So it was 3,10,640, right? 3,10,461. It means if I use this cost as a surrogated cost, if today I am incurring 5 lakh rupees, then the value of this 5 lakh was 3,10,641 before 5 years ago. Okay, it means I can do the splitting in such manner. What is my total cost? My total cost is 20 lakhs. 1, 2, 3, 4, 5. The total cost is 20 lakhs, right? My total cost is 20 lakhs. Okay. So what is my cost of engine? What is my cost of engine? My cost of engine which is arrived is 3,10,461, and cost other than engine is 20 lakh minus 3,10,641. Okay, so this could be the breakup according to this calculation, right? So we have arrived at that what could be the cost basis the current cost, right? I hope it is clear to everyone. So guys, in case of subsequent cost, you have to apply the same principle, right? You have to apply the same principle. What are the principle? Future economic benefit is probable. Of course, yes, cost can be measured reliably. If this is the case and there is major inspection, major overhauls, major replacement, you have to capitalize and add it to the cost of PPE. Sir, if I add this item to the cost of PPE, of course I need to de-recognize. I need to remove the existing item of PPE. Am I right? So I need to remove that. Otherwise it is a duplicate, right? So for de-recognition, either I should have aware about the original cost. If I am aware about the original cost, if the question has given you that the cost of the original engine is, let's say, 6 lakh rupees, so you have to use 6 lakh. But if the question has not given you, then standard says that, okay, use the current cost as a surrogated cost. Okay, and just find out the present value, that if today I am spending 6 lakh rupees, 5 lakh rupees, then what is the value of this 5 lakh or 6 lakh rupees 6 years ago, 5 years ago. Okay, so you can calculate the present value, and after that, so this will be the value of that component, and other than that component, you can reduce from the original price. You can reduce that value, and you will find the remaining value, right? Like in this particular case, I have done that. Is it clear to everyone, guys? Is it clear? Yeah. So we will discuss one particular case study, which is which is illustration number 8 from the Institute study material, and then we will be more clear how this recognition will happen in case of subsequent cost, right? So guys, it's 8:25 now. Let's have a 10 minutes break, and we will start at 8:35. Students, welcome you all after the break, and let's discuss the replacement cost case study, okay, which is illustration number 8 from Institute Study Material. And this, with the help of this particular illustration, we will be able to understand that in case of a replacement of, in case of a major replacement, how to do the accounting treatment. MS Limited has acquired a heavy machinery at a cost of rupees 1 crore 100 lakhs with no breakdown of the component parts. So there was a machinery and the cost of the machinery was 1 crore and there was no breakdown of the component parts, like there was no breakdown of truck and engine, right? The estimated life is 10 years and at the end of the 6th year, one of the major component, the turbine, require replacement, right? As further maintenance is uneconomical. So the life was 10 years, but at the end of the 6th year, there was a major component which is turbine of this particular machinery, and it requires a replacement, right? Because the maintenance is uneconomical and the entity wants to replace this part. The remainder of the machine is perfect. Apart from this turbine, the rest of the machinery is perfect and it can be usable for the next 4 years, right? And is expected to last for the next 4 years. The cost of a new turbine is 45 lakh. See, the cost of the entire machinery is 1 crore and only the cost of this turbine is 45 lakh. The discount rate assumed is 5%. Can the cost of the new turbine be recognized as an asset? And if so, what treatment should be used? First of all, guys, we need to understand, of course, this turbine. This turbine is an important component. Is it a PP? Is it this is a tangible item? It has to be used for more than 1 year. And of course, it is held for use in production or supply of goods and services. It is meeting the definition of PPE. The first thing is it should meet the definition of PPE. Yes, it is meeting the definition of PPE. Second, for recognizing this as a PPE, it should meet the recognition criteria. What is the recognition criteria? Future economic benefit is probable. Of course, if this turbine would not be replaced, it would not be able to use this machinery for the next 4 years, right? And the 4 years is left, right? So future economic benefit is of course probable and cost is already given in this question, which is 45 lakhs. So this criteria is also meeting and hence this subsequent cost has to be recognized as a property, plant and equipment. I mean to say it has to be added to the cost of the property, plant and equipment. Now the question arises, sir, the cost of the machine is 1 crore and this part was already there when the machine was purchased, right? So this 1 crore includes the cost of the turbine at the time of initial purchase. And today, I mean to say, when after 6th year, I am buying this turbine. So should I make the cost of this machinery as 1 crore 45 lakh, which is not correct, right? Because 2 turbines will not be used in a machinery, only 1 turbine will be used in a machinery, right? So there should be a cost of 1 turbine. Then what to do? The existing cost of the turbine should be de-recognized, should be removed. Sir, how can we remove the existing cost of turbine? So standard says that first of all, you need to use the current cost to derive at the past cost. That what was the present value of this 45 lakhs 6 years ago, right? So you need to discount it 6 years ago, right? So it will give you the present value. Clear? So when the present value will come, you will de-recognize that present value and you will recognize the cost of the new turbine. Okay, so let me solve this case study for you on an Excel file so that you will be able to understand this in a better way, right? Yeah. Illustration number 8 of study material. First of all, the new turbine will be added to the cost of the machine, and the existing turbine will be de-recognized, right? De-recognized. Now, how to arrive at cost of existing turbine? Cost of existing turbine So cost of new turbine. Cost of new turbine is 45 lakhs. 4, 5, 1, 2, 3, 4, 5. 45 lakhs. Discount rate is 5%. This is incurred after 6 years. 6 years. So present value 6 years ago. 6 years. So first of all, how to calculate the present value? You need to calculate the present value factor. You need to calculate the present value factor. And what is PVF? What is PVF in this case? In this case, what is present value factor? The present value factor is equal to 1 divided by 1.05. 1.05. I mean to say 1 plus 5% to the power 6, because this is incurring after 6 years. So I need to calculate the present value for 6 years, right? It is coming at 0.74622, right? So in that case, what is the present value? What is the present value? In this particular case, what is my present value? My present value would be 45 lakh multiplied by, 45 lakh multiplied by present value factor, right? So 3357969. 3357969, right? 3357969. I can round it off in the next. I can round it off in the hundreds, and I can call it as a 3358. 3358 000, right? 33,58,000. Can I do that? Yes. So I have rounded off in the nearest 10, right? Nearest 100. So 33,58,000 is the cost of the original turbine, right? Now let's do some calculations. And how you can do this calculation? First of all, what is your original cost? Original cost. So let's write down first of all machine. Write down a turbine here and write down machine other than turbine, right? Other than. So turbine and machine other than turbine. Clear? And let's say, and write down the total cost here. Total cost. Turbine, machine other than turbine, and total cost. Yeah. So what is the original cost of turbine which has been derived by the present value? With the help of the present value, 33,58,000. What is the total cost? The total cost is 1 crore. 1, 2, 3, 4, 5, 6. Yeah, 7. 1 crore. Am I right? So 100 lakhs. 1 crore means 100 lakhs. Yeah. And what is the cost of machine other than turbine? So it is this minus this, right? 66,42,000. I hope it is clear to everyone, guys. I hope it is clear to everyone. So now the next concept is accumulated depreciation. Accumulated depreciation. Now tell me how much depreciation must have been calculated so far, must have been taken so far. So far the cost was 1 crore and the useful life was 10 years. So what was the total depreciation? The total depreciation must be 10 lakh rupees every year. Am I right? So already 6 years have been elapsed So on this turbine, how much depreciation has been already recognized, already booked? So 33,58,000, and the life was 10 years. Earlier the life was 10 years. So 3358 divided by 10 multiply by 6, right? So probably 20 lakh of depreciation has already been taken on this turbine. And on this machine other than turbine, how much depreciation must have been taken so far? 6342 divided by 10 multiply by 6. So this should be 60 lakh. Am I right? This must be 60 lakh. Sum of these two. 60 lakh, right? So the cost was 1 crore. The life is 10 years. So what is the per annum depreciation? 10 lakh. How much year has already lapsed? 6 years. So 10 lakh multiplied by 6, 60 lakh, right? The total depreciation is 60 lakh. The total cost is 1 crore. What is the net block? What is the net book value? What is the carrying amount? What is your net book value? Your net book value of the turbine comes out at 13,43,200. Your other than turbine 26,56,800, and your net block total level 40 lakh, right? Now what will be the accounting entry? What will be the accounting entry? I hope you guys have understood so far. You guys have understood so far. Vidula, you are saying that 35,25,868 to be derecognized. So it is not 35,25 Vidula, it is 33,58, right? 33,58. Is it clear? Is it clear? Yeah. So what is the accounting entry? What is the accounting entry? The accounting entry would be, first of all, the net book value of this turbine needs to be derecognized. The net book value of the turbine should be derecognized. So first of all, you need to derecognize, you need to credit to old turbine within bracket machine, old turbine PP, right? You need to credit this old turbine PP with your original cost, because you have to credit original cost and you have to debit accumulated depreciation old turbine, right? So net will be 1343. Accumulated depreciation old turbine debit. So this will be your 2014,800, right? So this will be debited, this will be credited, right? And where the differential will go? Where the differential will go, guys? The differential will go debit, loss on derecognition, right? What is the loss on derecognition? 3358 minus 2014. 1343,200 is the loss on derecognition. One more debit will come. What is? New turbine PPE debit. Okay, by how much amount? 45 lakh. What will be the credit? What will be the credit? To bank account. 45 lakh. Let's see the total of the accounting entries tallying or not. Let's see. Yeah. So this is getting tallied, right? I hope you guys are able to understand that how I have solved this particular question, right? I hope you guys are able to understand. The new turbine will be added to the cost of the machinery and existing turbine will be derecognized. So how we have arrived at the cost of existing turbine, you have seen that. How we have arrived at the cost of the existing turbine. Okay. So the cost of the existing turbine is 3358. And just we have calculated the accumulated depreciation on the basis of 10 years of useful life, but 6 years has already been elapsed. So we have arrived at a net book value of 1343,200, and this will be the loss on derecognition, right? And the new turbine will be the added to the cost of PPE, right? Cost of the machinery. And so in this case, what will be my revised gross block? My revised original cost will be 6642 plus 45 lakh, right? So if I talk about my revised, let's say if I'll do this particular new thing, so what is my revised block? Revise. So in this case, my cost, first of all, let me talk about my original cost. Okay, revised cost. So let's write it as a or revised cost. Revised cost. What is the cost of turbine? 45 lakh. What is the cost of machine other than turbine? Original cost. I'm talking about the gross block. 6642. What is the total? The total comes out at this. Okay. Then you need to write down the accumulated depreciation. What is your accumulated depreciation? Your accumulated depreciation is 0 in this case. On this, at the time of initial recognition of turbine, of course, this accumulated depreciation is 0. I am talking about the revised at the end of 6 years. What is the accumulated depreciation for this machine other than turbine? It is 39,85,200, right? What is the total? The total is this one. Then what is the net book value? This is this minus this. 45 lakh. And this is 26,56,800, and this is the total net block will be 71,56,800. So the net block of 40 lakh will become 71,56,800, right? Because this 45 lakh has been added. So earlier the net block was 40 lakh. Okay. So after derecognition of this 13,43,200, it become 71,56,800, right? So what will be the prospective depreciation? So this will be depreciated in the next 4 years, right? In the next 4 years. So what will be the prospective depreciation? The prospective depreciation per annum. Prospective depreciation per annum. The prospective depreciation per annum will be this divided by 4, and this is also this divided by 4, right? So yearly depreciation will be your 11 plus 6. 1789 will be your yearly depreciation. So in the next 4 years, this 71,56,800 will become 0. I hope you guys have understood this particular question. I hope you guys have understood. Let me know if you have any query. Yes, Tarush. So we have used the current price of 45 lakh to arrive at a 6 years ago value, right? What was the value 6 years ago, right? So then I have splitted the original cost of 1 crore between turbine and between other than turbine, right? And it's already been 6 years and the original life was 10 years. So we have calculated depreciation as per the 10 years useful life. So I have calculated what is the depreciation till 6 years end, right? So this has given me the net block of the turbine. And since this net block of turbine is of course a loss on derecognition, sir, what happens if I got some scrap value of, let's say, 5 lakh rupees? In that case, this scrap, well, in that case, the accounting entry will be bank account debit to old turbine by extent of 5 lakh rupees, and your loss will be reduced by 5 lakh rupees because you are getting as a scrap value, right? Is it clear? So that has to be reduced from the loss on derecognition. Friends, let me know if you have understood this particular case study. Let me know if you have understood. Otherwise, I'll repeat and I'll ensure that you guys should understood this case study, right? So this is the solution which is there on the PowerPoint presentation. This is the solution which is given under the study material, right? So you guys, in the form I have presented in my Excel file, you guys can present in that way also, right? The new turbine will produce economic benefit to MS Limited and the cost is measurable. So this item should be recognized as an asset. The original invoice of the machine did not specify the cost of the turbine. However, the cost of the replacement of 45 lakh can be used as an indication of the likely cost 6 years previously. If an appropriate discount rate is 5% per annum, 45 lakh discounted back 6 years amounts to 33,57,900. So in the study material, this has been reduced to the 900. So what I have done, I have just made 969 to 1000, right? So whatever you will do, that is correct. Don't worry about that. The current carrying amount of the turbine which is required to be replaced of 1343,160 would be derecognized from the books of account. That is original cost as reduced by the accumulated depreciation for past 6 years. Assuming depreciation is charged on a straight line basis. The cost of the new turbine would be added to the cost of the machine, resulting in a revision of carrying amount to the machine by 71,56,000. Okay. The original cost of machine reduced by accumulated depreciation till the end of 6 years, right? So this we have already done. Now let's discuss about the major inspection or overhauls. So guys, in some industry, for example, in case of a aircraft, aviation industry, right? So if you see the balance sheet of Interglobe Aviation Limited, if you see the balance sheet of Indigo Airlines, you will find in the property, plant and equipment, you will find there is a component of inspection cost, right? So why? Because sometimes there are some industry which is dealing with the lives of the people. For example, in the aircrafts, of course, the aircraft is flying high in the sky. So of course, they're dealing with the life of the masses. Am I right? Because one has to, fly and one has to just reach at that another destination. So if this airplane got crashed, or if there is any problem which arises in the airplane, of course, it would be highly riskier, right? It would be a high risk. So you cannot expect that anybody will survive if the plane got crashed, right? So in some industry, the regular major inspection for faults may be a condition to continue to operate an item. So in case of aviation industry, what this aviation industry does, the aviation rule says that at the 3 years interval or at the 5 years interval, you have to do the major inspection of the aircraft. Doesn't matter that it is flying perfectly fine. Doesn't matter it is running perfectly fine. Still, you have to go through with the major inspection. And let me tell you, the inspection cost is not like a 20,000 rupees or 10,000 rupees. The inspection cost is into lakhs, right? For example, 10 lakh rupees, 15 lakh rupees, 20 lakh rupees, 5 lakh rupees. So the inspection cost is a major component of the aircraft. So when this aircraft came, when the company has bought the aircraft, of course, it was inspected aircraft, right? So when you buy a commercial vehicle, it is fit for roads, right? It is fit for running. So there is already a there is a fitment certificate was there, right? But after some period of time, you have to get that fitment certificate from the authorities. So in this case also, when the company has bought the aircraft was already inspected, right? And inspection has some cost. It means this inspection cost is already consumed in the cost of the aircraft, right? And life of the aircraft is, for example, 20 years. Life of the aircraft is 20 years. But it has to go to the major inspection at the interval of every 5 years. It means in the life of the aircraft, this inspection cost has to be incurred 4 times in the life of the aircraft, right? So what does it mean? It means this inspection cost is a separate component, is a separate cost. And whenever you incur the inspection cost, you need to capitalize this inspection cost as a cost of the aircraft, and you need to decapitalize or derecognize the original or existing cost of the aircraft, right? So friends, Ind AS 16 says that if there are different components like inspection, like major inspection, like major component, for example, engine, for example, turbine. So these component has to be capitalized separately if you are aware about the cost. If you are not aware about the cost, then what you will do at the time of the inspection or at the time of the major replacement or major expenditure, you need to arrive at a present value, that if today's value is X amount, then what was the value 5 years back? Then what was the value 10 years back? What was the value 6 years back? By doing this discounting calculations, right? So friends, this is the same case which we have discussed just before. The only thing is it is talking about major inspection, which is required at every frequent intervals, which is part of the requirement of the law. So regular major inspection for faults may be a condition to continue to operate an item. Right. The cost of each major inspection is recognized in the carrying amount as a replacement if the recognition criteria is satisfied. Of course, yes. If this inspection will not happen, this aircraft is not allowed to carry the passengers. So of course, if the inspection will happen, there will be a future economic benefit, and we are aware about the cost, right? We are aware about the cost as well. Is it clear? So any remaining carrying amount relating to the previous inspection is de-recognized, irrespective of whether previous inspection was separately identified and depreciated. Same way. So whatever previous remaining amount was there, whatever remaining carrying amount was there relating to the previous inspection, it has to be de-recognized, irrespective whether that time that inspection cost was, separately recognized or not, separately identified or not. But yes, if today you are incurring an inspection cost, you have to arrive at a last or original inspection cost. You have to de-recognize that, and you have to capitalize that today's cost, right? Same in the same manner what we have just done in the case of a truck example, and in the cost of, in the case of a machine and turbine example, right? So let's do this case study 3. Udan Limited buys an aircraft for rupees 90 lakhs. Under civil aviation rules, the aircraft requires a major inspection every 3 years at a cost of 5 lakh. Right. So normally 3 year, at every 3 year, the cost, the inspection has to happen at a cost of 5 lakh. 3 years after purchase, it undergoes its first major inspection. The cost in relation to this inspection amounting to rupees 7 lakh. So when the company has bought the aircraft, the cost was 90 lakh, which is inclusive of 5 lakh rupees of inspection cost. Okay. And after 3 years, it has gone through a major inspection, and the cost for this major inspection was amounting to rupees 7 lakhs. The cost was amounting to rupees 7 lakh. Clear? The cost is 7 lakh. Assuming the life of the aircraft, is 20 years, right? Is 20 years. Explain how the same should be accounted for in accordance with the requirement of Ind AS 16. So guys, first of all, the original carrying value would have been allocated as follows. And how this would be? The cost of the aircraft is 85 plus cost of inspection is 5 lakh. So these are the two components. When you prepare a fixed asset register, and you can see the balance sheet of Indigo Airlines Limited. So they are splitting the cost of the aircraft into inspection cost and aircraft cost, which is other than inspection, right? So this total comes out at 90 lakh rupees. This total comes out at 90 lakh rupees. The total comes out at 90 lakh rupees. 85 lakh rupees is the aircraft cost, and inspection cost is 5 lakh rupees. Ind AS 16 provides that in such case, original cost of inspection is de-recognized, and the new inspection cost will be recognized in the carrying amount. So new inspection cost will be accounted for as an asset addition, and the original asset cost and the original inspection cost as an asset disposal. So in this case, what we are required to do? This aircraft is 85 lakh, will not touch this amount. But as far as inspection component is concerned, what is the original cost of inspection? It was 5 lakh. So you need to de-recognize the 5 lakh rupees, right? And you need to recognize the 7 lakh rupees. So this 85 plus 7 is equal to 92 lakhs will be the revised gross block of this aircraft plus inspection. Is it clear to everyone? And friends, let me tell you, if on the day one you are aware about the cost, and if it is a major component which is having a different useful life, so that major component has to be depreciated over that particular useful life only. For example, in this case, this 85 lakh has to be depreciated over a period of 20 years. This 5 lakh has to be depreciated over a period of 3 years, because I am aware that after 3 years, this does not have any value. After 3 years, a new cost will be added, right? So this inspection has a life of 3 years and this aircraft has a life of 20 years. So 85 needs to be depreciated over a 20 years period and 5 lakh needs to be depreciated over a 3 year period. Because on the day one, I am aware about the life. But sir, in the earlier case, you have depreciated over a 10 year period because at that point of time, I was not aware. The life of the truck was 10 years and my expectation is that every component will run for 10 years except small repairs, right? Except small spare parts, right? So, but the breakdown happened and after 6 years, I need to replace this turbine or engine. So this was not a planned cost. This was not a planned. Okay. So that is why we have depreciated everything over a period of 10 years till 6 years, right? But here, if on the day one, I am aware that I need to go through with the major inspection over a period of 3 years or 5 years. So of course, I need to allocate the cost and I need to depreciate that cost over that period only. And practically in Air India, Indigo Airlines, Vistara Airlines, these are doing this, right? Good. Clear. So many students have replied that they have understood this concept. Great, guys. All right. So friends, we have discussed the recognition criteria in terms of initial cost as well as subsequent cost. Now we are going to discuss measurement at initial recognition. Sir, we have just identified that yes, this has to be added to the cost of the asset, right? And this has to be recognized as an asset, as a PPE. Sir, at what value we need to recognize? How we will arrive at a value? Measurement at initial recognition. So friends, coming to the measurement at initial recognition, first of all, standard talks about that the PPE has to be initially measured at cost. It has to be initially measured at cost, right? And when I say that it is initially measured at cost, what is my cost? Just think about what is my cost. Just think about. For example, you have a factory in Delhi and you have purchased a machinery from China. So if you have purchased a machinery from China, of course, there is a cost price of the machine, there is a purchase price of the machine. And when that machine, you will purchase that machine from China, you will pay a cost of the machine, you will pay an import duty to the custom authorities. When it landed to India, you will pay a GST, goods and service tax, right? Then you need to pay a transportation cost from the supplier place to the China port, Shanghai port. From Shanghai port to the Kandla port in India, you have to pay a transportation cost. And from Kandla port to Delhi factory, you have to pay again a transportation cost, right? Then for installing this particular machine, you have to do some extractions, you have to do some installation cost, you have to incur some assembly cost, right? So if this machine require training, you need to just engage a trainer and you need to also incur some training cost, right? So guys, just think about at what value this machine needs to be recognized. Do I recognize this machine at a cost price which I'm paying to the supplier who is based out of China? Or do I need to capitalize all these expenses which is related to the machinery? So what is the general principle? The general principle says that any cost which is incurred for bringing the asset, any cost which is incurred for bringing the asset into the location and condition necessary for it operating as per the intended by the management. Any cost which is incurred to bringing the asset into the location, it means any cost which is incurred to bring the asset into the factory of the company, right? Bringing into the location and condition. Of course, I have purchased this machinery and I have just put this machinery into the warehouse of Delhi factory. So it does not serve any purposes. So it has come to the location, but it has to bring down into the condition so that it can be used as intended by the management. So what I need to do, I need to install this machinery. I need to do some preparation cost, site preparation cost, assembly cost. I need to call for the trainer. I need to call engineer so that this machine can be started. Right. So I have to do the trial run of this machinery so that I am aware that yes, this machine is good to produce goods, right? So I have to incur those costs. So friends, standard says that at the time of initial recognition, you have to measure it at cost. And what is the definition of cost? It says that purchase price, including import duties and non-refundable purchase taxes. When I'm saying non-refundable purchase taxes, I mean to say if there are non-refundable purchase taxes, these are going to be capitalized as a cost of the asset. If there are refundable taxes, for example, I have paid GST for purchase of machinery and I'll get an input credit of GST. So this will not be my cost, right? Because I'll get the input, right? So this is not my cost. But if I'll apply the GST, if I paid the GST for purchasing of some capital goods and I'll not get the credit, in that case it become a cost of the asset, right? So that is why it has been written as a non-refundable purchase taxes. After deducting trade discount and rebates, and if the company is getting some trade discount and rebates, this has to be deducted, right? Directly attributable cost. What is meant by directly attributable cost? Directly attributable means cost which is incurred for bringing the asset into the location and condition necessary for operating it as intended by the management. It means directly attributable cost means the cost which is directly incurred for this particular asset. If this asset would not be there, this cost would not have been incurred. If I would not have purchased the asset from China, I would not have incurred import duty, this GST, this transportation cost from Shanghai port to Kandla port to Delhi factory, this installation cost, assembly cost, site preparation cost, engineer cost. These costs I would not have been incurred if I would not have been purchased this machinery. Okay, so directly attributable cost means the cost which is directly related to that asset, directly related to that asset, directly incurred for bringing the asset into the location and condition necessary for it to be operating as intended by the management. I hope it is clear to everyone, guys. I hope it is clear to everyone. Yeah, is it clear? Directly attributable cost, is it clear? Third, so first part is clear to everyone. Second part is directly attributable cost. We will do some case study also. Initial estimate of the cost of dismantling and removing the item and restoring. What does it mean? So guys, if you see the balance sheet of Reliance Industries Limited, you will find an asset retirement obligation or a site restoration cost. You will find this word. If you will see the balance sheet of Indus Towers Limited, you will find this asset retirement obligation or site dismantling cost as a provision. And this cost has been added to the cost of asset as well. So like Reliance Industries has a oil well in the Krishna Godavari basin, right? So they have an oil well in the Krishna Godavari basin. And they got this oil well from the government of India for let's say 30 years. Okay. And there is a contract with the government of India that whenever they will leave this oil well, whenever they will leave this place, they have to restore the seabed. They have to restore the seabed in the same condition in which it is given by the government to them. Right. Second example, I have taken a land on a lease basis. A company has taken a land on a lease basis. And the company has constructed a factory over that lease, over that leasehold land. And the leasehold land is for a period of 50 years. There is a contract. Whenever this 50 years will complete, the tenant has to return the land in the same condition in which it was given it to the tenant, right? So the tenant has to restore the land. So when the tenant has to restore the land in the same condition, it means the tenant has to dismantle this entire factory, right? So there will be some dismantling cost in future. There will be some asset retirement obligation in future. There will be some site restoration obligation in future, right? So standard says that if there will be some cost which will arise in future, why? Because we are entering into a contract today, because we have installed this asset today, and that is why we will incur some cost in future for the removal of for the removal or restoration of such assets. In that case, the estimated cost of the future, the estimated future cost of this site restoration obligation, asset restoration obligation, has to be added to the cost of the asset, right? For example, what practically these companies are doing, for example, Bharti Infratel Limited or Indus Towers Limited, how this Indus is doing, Indus Towers. So they are constructing a tower site. They are constructing a tower sites, right? So they are constructing a tower sites on the leasehold land, on the leasehold land for 20 years, right? So today, so after 20 years, of course, they have to dismantle the tower. They have to remove the civil work. They have to restore the land in the same condition in which it was given to them. So of course, it will carry a cost, right? So today they have installed a tower site, and after 20 years, they have to remove this. And for example, for this restoration and removal cost is, let's say today it is 1 lakh rupees. It is 1 lakh rupees today, but this cost has to be incurred after 20 years. So what they will do, they will take an impact of inflation. For example, current cost is 1 lakh, then what will be the estimated cost after 20 years? If today I am spending 1 lakh rupees and inflation is 6%, so of course I will spend 1 lakh multiply by 1 plus 6% after 20 years, right? So probably I will incur, let's say 15 lakh rupees after 20 years, probably, or let's say 10 lakh rupees after 20 years. So then I discount the future estimated cost to the present value today. So if after 20 years this cost will be 15 lakh rupees, then what is the current cost? When I say current cost, it is not 1 lakh rupees. It is a discounted. First, I have arrived at a future cost. Then I have discounted this future cost to the current cost, right? With the help of the present value concept. And that present value will be added back to the cost of the asset, right? So friends, as far as measurement is concerned, the property, plant and equipment has to be initially measured at cost. What is meant by cost? Cost means purchase price, including import duties and non-refundable taxes after deducting trade discount and rebates. Okay. The second one is directly attributable cost. The third one is initial estimate of the cost of dismantling and removing the item and restoring. Nothing. It is asset retirement cost, site dismantling cost. Okay. So this is site restoration cost, right? So this estimated cost is also taken into consideration for calculating the cost of the asset, right? Sairam is asking, sir, if one company has purchased a machinery and this machine was installed in Mumbai branch, and after a period this machine was transferred to another branch which is located in Pune, the company paid some expense to install that machinery in Pune, then that expense can be added in machinery. So Sairam, this has to be taken as, you know, derecognition of the existing cost, existing installation, and recognition of the new installation. Either you can do that, or if this installation is not identifiable and if it is a very small amount, in that case, the new installation can be charged to P&L, right? So Sairam, it is not like that every time I'm deinstalling and I'm installing this machinery at different places, I have to add back this installation every time. So this is not the case. For example, if you have purchased a machinery in the warehouse, then you have sent the machinery onto the site, on the factory, and from one factory you are sending it to another factory, to another factory. So every time you are incurring a transportation cost. So once you have capitalized and just you are moving this machinery to on a pan-India basis, it does not mean that every time you will capitalize the transportation cost. It will go to P&L, right? So like in this case, this will go to P&L, right? And if it is a major cost, you can derecognize the original cost and you can recognize the new cost, right? So you can take this as a major replacement, right? Vidula is saying, is it 11, 15, 812? So Vidula, let me calculate on Excel. So if 1 lakh rupees is the current cost, and if the discount, if the inflation rate is 6%, for example, 6%, then my future cost will be 1 lakh multiplied by 1 lakh multiplied by 1 plus 6% to the power 20. So it is coming out at 3,20,714. It is coming out at 3,20,714, right? So 1 lakh value will be 32714, and for example the discount rate is, let's say, 10%. In that case, what is my present value? My present value would be 3,20,714 divided by 1 plus 10% to the power 20. So it is coming out at 47,672. So this will be added to the cost of the asset, right? This will be added to the cost of the asset. What will be the accounting entry? Accounting entry will be asset retirement obligation asset. Okay, cost debit. So this will be debited. Credit will be, because you are just recognizing a future cost, present value of future cost. You are not paying anything. So this will be ARO obligation. ARO obligation provision. So this will be a liability. Okay. So this will be 47,672. This will be credit. Right? This will be credit. I hope it is clear to everyone, guys. Yeah. So friends, what could be the example of directly attributable cost? Cost directly related to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management. I have told you. So what could be the directly attributable cost? Employee benefit costs arising directly from the construction or acquisition of PPE. So you're constructing a factory. Your employee are engaged for the purpose of construction. Your labor is engaged for the purpose of construction. So in this particular case, your labor is engaged for the purpose of construction. So in this particular case, the salary or wages of the labor or employee will be added to the cost of the factory. Right? Cost of site preparation. Right? For example, for installing a machinery, you are just doing some excavation, you are doing some civil work. Okay, you are preparing your site. So this cost of site preparation is also part of your cost of asset, directly attributable cost. Initial delivery and handling cost. So initial delivery and handling cost is also your part of directly attributable cost. Installation and assembly cost is again part of your directly attributable cost. Professional fee, if you are paying some professional fee, it is again part of your directly attributable cost. Cost of testing, for example, you have seen that in case of metro, they are doing a trial run. In case of factories, they are doing a trial run. So they are just testing whether my asset is in line with what my intention is there or not, right? So just they are doing a testing, they are doing a trial run to check whether the asset is working properly or not. So those trial run expenses is also going to be capitalized. These are the directly attributable costs. But if something which is there from the trial run, some output is there, some revenue is there, so that revenue or output has to be deducted from the cost of the trial run. For example, in case of a metro, let's say at the time of trial run, so metro is inviting passenger, whomsoever wants to, wants to do this metro ride in the trial run period. So they will be eligible for a discount of 60% on the fare, right? So they are getting 40%. So whatever they are getting, it has to be reduced from the cost of the trial run, right? What are the examples which cannot be directly attributable cost? What is not directly attributable cost? Cost of conducting a business in a new location or with a new class of customer. Okay, for example, the company has a factory in Delhi, right? Now the company is shifting its plant from Delhi to Chennai. So for that purpose, the company is providing training of English communication, English spoken course to all its employees. The company is giving a training for English spoken to all the employees. So this staff training is not a directly attributable cost, which has to be capitalized as a cost of the asset. This staff training cost has to go to the P&L. right? So cost of conducting business in a new location, right? So like relocation cost, we are relocating our plant from Delhi to Chennai. So the cost of relocation, the cost of conducting a business in a new location is not a directly attributable cost, right? Cost incurred in introducing a new product or service. For example, we have incurred an advertisement cost. We have incurred a campaigning cost, right? We have incurred a advertisement cost for just promotion of a brand, promotion of a product, right? For introducing a new product or service, right? So in that case, this is not going to capitalize. Advertisement cost is going to be charged to the P&L. Cost of opening a new facility, okay? And for inaugurating a factory, we have invited Amitabh Bachchan just to cut the ribbon of the factory. Or we have just, we have invited our chief minister. And for that chief minister, so we have done a huge arrangement for the opening of this factory, okay? Or we are paying a huge cost to Mr. Amitabh Bachchan to cut the ribbon of that factory, okay? So in that case, if there is a cost of opening a new facility, so of course it is something which is afterwards when the asset has been bring into the condition and location necessary for operating in as per the intended by the management. So these kind of costs are not going to be capitalized. Rather, these kind of costs will be charged to P&L, right? Administrative and other general overhead costs, for example, audit fee. Yeah, for example, finance department expenses, right? So these kind of administrative and other general overhead costs will also charge to P&L. This will not add it to the cost of the asset. So these are the example which is given in the standard, right? I hope it is clear to everyone, friends. Decommissioning cost we have discussed. That decommissioning cost means cost towards dismantling and removing the asset and restoring the original site after use, right? So it includes the dismantling of asset. It includes the restoring of the site in the same condition. For example, we have done some civil work in the land. So we have to remove that civil work and we have to fill the soil in that land and we have to get this land back into the same condition in which it was given to us, right? So corresponding obligation, like I have told you, the accounting entry will be ARO asset account debit to ARO liability account. So the corresponding obligation will be recognized as a provision under Ind AS 37. For example, building an additional internal wall with condition that the property will be returned in original state at the end of lease, right? So these kind of things will typically arise in oil and gas, mining and electricity industries. And even though in case of telecom companies as well. Okay. Let's do the case study 4 to understand the measurement at initial recognition. ABC Limited purchased a furnace machinery for a gross price of rupees 200 crores. The seller granted 0.5% rebate on the gross price of the machinery. The gross price includes excise duty of rupees 20 crore for which input credit can be claimed by the company. It means this excise duty is a refundable tax. It is refundable or non-refundable? It is refundable tax because the input credit can be availed. So the gross price is 200 crores and the seller will get a rebate of 0.5%. It means the seller will get a discount of 1 crore. And the gross price also include excise duty of 20 crore. The gross price include excise duty of 20 crore as well. This 20 crore is a refundable tax. It is the input credit will be received on this 20 crore, right? The input credit can be received on this 20 crore. Clear? So friends, if you look at this particular case study, your gross price is 200 crores and 1 crore is trade discount and rebate. And 20 crore is the excise duty on which the refund is there. I mean to say the input credit can be claimed. So what is my cost of the machinery? What is my purchase price, including your import duties, including non-refundable taxes? It is a refundable tax. Minus trade discount and rebate, it comes out at how much? 179, right? 179. Is it clear? So 200 minus 1 minus 20. It is coming out at 179. Clear? It also incurred 15 crore as a transportation cost, handling charges and insurance, rupees 5 crore for installation and 3 crore for testing and professional. Right? So these are the directly attributable costs. 15 crore is the transportation cost, handling charges and insurance. 5 crore is installation cost. 3 crore is testing and professional fee. So guys, it's 15 plus 5 plus 3. 15, 5, 20 and 20 plus 3, 23 crores will be added as a directly attributable cost. And it has also earned 0.2 crores from selling goods produced out of testing. So whatever has been earned out of the trial run period, so that has to be reduced. So 0.2 crore has to be reduced. So transportation, handling and insurance 15 crore, installation charge 5 crores, testing and professional charge 3 crores, 0.2 crore is my revenue. So 3 minus 0.2, 2.8 crore. So this has to be added to the cost of the asset, right? The company borrowed rupees 100 crores for financing the new purchase at the rate of 10%. And this company has borrowed funds for this machinery, right? For rupees 100 crores. And this entire process of purchase to make the operation took 15 months and the loan was outstanding during the period. What to do? The company has taken a loan for getting this machinery, okay, for installing this machinery, for using this machinery. The company has taken a loan of 100 crores and it took around 15 months to complete this entire process, right? To complete this entire process, to make this asset ready for use. So what to do? Borrowing cost is there. So 100 crores multiply by 10% multiply by 15 divide by 12. So you have to add the borrowing cost, right? You have to add the borrowing cost as well. So what is the borrowing cost which is going to be capitalized? The borrowing cost which is going to be capitalized is 100 crores multiply by 10% multiply by 15 divide by 12. So 12.5 crore will be the borrowing cost which is going to be capitalized as per borrowing cost standard. And I hope you guys have already covered this borrowing cost standard, right? Since the loan was outstanding, so I have taken the entire interest for this particular period. Clear? The company earned rupees 0.1 crores from short-term parking of the money borrowed pending payment to supplier and meeting all costs. So out of this 100 crores, because 100 crores has not been spent on day one, right? So the company has invested these money into short-term fixed deposit. And out of this short-term fixed deposit, the company has earned 10 lakh rupees, 0.1 crores. So of course, this 0.1 crore needs to be deducted from the cost of the borrowing. So 12.4 crore is my cost of asset. So 179 plus 15 plus 5 plus 2.8 plus 12.5, 12.4. 216.20 is the initial cost of the machinery. It has to be added to the cost of machinery. And what is my measurement at initial recognition? My measurement at cost is 216.20. Okay, so my initial cost of machinery is 216.20. I hope it is clear to everyone. Friends, let me know if you have any question. I hope you guys have understood this. Let me know if you have any question. Saina, Vidula, Srinidhi, Mia, Tarush, Utkarsh, Tanushri, Priya. Do you have any question? Great. Good, guys. Yeah. Coming to the second concept of deferred payment credit. So friends, so measurement at recognition we have discussed. And while discussing the measurement at initial recognition, we have understood that initially it has to be measured at cost. Cost includes purchase price, including import duties, non-refundable taxes, less free discount and rebates, plus directly attributable cost, plus dismantling or asset retirement obligation which will arise in future, right? So we have understood that. Now the second concept is deferred payment credit. So at times when you went to buy the fixed asset, for example, I went to an automobile dealer and I'll say that I need a car. So what is the price of this car? So he'll say that the price of this car is 10 lakh rupees. But when I'll tell him that I'll pay you in the 3 installments, which will be due after the end of the every year. So I'll pay you 1/3 after the end of first year. Well, I'll pay you the second 1/3 after end of the second year. And I'll pay you the third 1/3 portion at the end of the third year. Right. So friends, when I tell him that I'll pay you over a period of 3 years, So he'll tell me the price is not 10 lakh rupees. The price is 15 lakh rupees or 12 lakh rupees. So now the question arises, whether I should recognize my fixed asset, whether I should recognize my property, plant and equipment at 10 lakh rupees or at 12 lakh rupees. If someone who has purchased this property, plant and equipment from his own funds, so of course he'll end up paying 10 lakh rupees. Someone like me who is paying in 3 installments, who is enjoying the deferred payment credit, so he is recognizing at 12 lakh rupees. So there is a disparity between the two different companies. One is using their own funds, one is taking the funds from the one is taking the borrowing and using those funds, you know, for purchase of the asset, right? So there is a difference in the value of the fixed asset, which is not right. So going by the substance, since why he is paying extra, he is paying extra because he is enjoying a deferred payment credit terms, right? So it means he is paying an interest over that, right? So going by the substance of the transaction, this transaction is not only a purchase of PPE. This transaction is purchase of PPE plus payment of interest on the finance, interest on the borrowing. So standard says that if the asset has been purchased on deferred payment credit terms, then the cost of the PPE, then the cost of an item of PPE is the cash price equivalent at the recognition date. What is the cash price equivalent? What is the cash price at the recognition date? So at that price, it has to be added to the cost. It has to be recognized as a cost of the asset. Sir, but what is the difference between the cash price equivalent and the amount which we are actually paying? So the difference will be recognized as an interest, right? So in case payment is deferred beyond normal credit terms, the difference between the cash price equivalent and total payment. So total payment minus cash price equivalent is equal to interest expense. Okay. And such interest expense has to be charged to P&L except if Ind AS 23 borrowing cost standard tells you that such interest is going to be capitalized. Why? If that asset is a qualifying asset and which is taking a substantial period of time, if that asset is a qualifying asset, in that case, such interest will be capitalized. But if that asset is ready for use asset, for example, I bought a car. So when I bought a car, that car is ready for use. That car is available for use, right? When I bought the car. So that car is not a qualifying asset. So in that case, the interest on car has to be charged to P&L, right? But if I am constructing a factory, of course it is a qualifying asset, and in that case, whatever interest I am paying, that has to be added to the cost of the factory, right? So friends, the basic idea is the asset has to be recognized as at a cash price equivalent, and the difference between the payment and the cash price equivalent is an interest. Now, if Ind AS 23 permits, then such interest will be capitalized. If it does not permit, then such interest will go to the P&L, right? So let's discuss one case study on this. Illustration number 1 of Institute study material. On 1st April 2001, an item of property, plant and equipment is offered for sale at rupees 10 million, right? With payment terms being 3 equal installments of 33, 33, 333 over a 2-year period, right? So on 1st April 2001, an item of property is offered for sale at rupees 10 million. So guys, on 1st April 2001, what was the value of the property? The value of the property was 10 million. It means 1 crore. 1 crore, right? 100 lakhs. With payment terms being 3 equal installments of 33, 33, 333. There are 3 equal installments, right? So 1, 2, 3. And 3 equal installment is 33.33 lakhs, right? Over a 2-year period. So this 3 installment has to be paid over a period of 3 years. Over a period of 2 years. Payments are made on beginning 1st April 2001. So the first installment has to be paid upfront at the time of buying the asset. And the second installment has to be paid at the end of the first year. The third installment has to be paid at the end of the second year. The implicit interest rate is 5.36% per annum, right? So guys, the property is offered for sale at 10 million. And when this property is offered for sale for 10 million, the payment was structured like the payment has to be made in 3 installments. The first installment has to be paid at the beginning of the period when the company is buying the asset. And the second installment has to be paid at the end of the first year. The third installment has to be paid at the end of the second year, right? So these 2 installments has to be paid at the end of the first year and the second year. It means this 2 installment is having a financing component, right? And the interest rate, the discount rate is given at 5.36% per annum. So how to calculate the value of this asset which has to be taken into the books of accounts as a cost of PPE. So let me take you on the Excel file. Let me know if my Excel file is visible, guys. Illustration number 1 of Institute study material, right? Illustration 1 of study material, and which is on deferred payment credit. Which is on deferred payment credit. Okay. So first of all, I need to calculate the cash price equivalent, right? So how to calculate the cash price equivalent? So first of all, since this transaction, there is a deferred payment credit. So calculation of first step 1. Calculation of cash price equivalent. Right? So how to calculate the cash price equivalent? First of all, just put the year or period. Let's say period. So what is the date? 1st April 2001, right? Then 31st March 2002, right? Then 31st March 2003, right? So beginning, at the end of the first period, at the end of the second year. Then amount. So I need to payment. What is the payment? 33,33,333, right? So these are the amounts. Clear? I hope it is clear to everyone. So this is the amount, right? Now I need to calculate a present value factor. So present value factor at the rate of 5.36% per annum. 5.36%. Now tell me, for the first installment, will there be any present value factor for the first installment? Answer is no. There will not be any present value factor. Why? Because the payment is going to happen at the beginning of the period. So the present value factor is nothing, 0. There is no present value factor, right? There is no present value factor. It is 0. Clear? It is 0. The present value factor is 0. So when I say 0, it is 1. I mean to say not 0, it is 1, right? So the time value, there is no time value of money. So whatever I am paying, so that is my current price. That is my present value, right? So it is 1. Clear? So what is my present value? Is it clear, guys? So there is no time value of money because I am doing the payment right now. Whenever I am purchasing the asset, I am upfront making a payment. Upfront I am making a payment, right? So I don't know why this is doing like this. 33. Okay. Yeah. Clear? I hope it is clear to everyone, friends. I hope it is clear. Now, at the end of the first year, what will be my present value factor? 1 divided by 1 plus 5.36%, right? So it is 0.949. It is 0.94. Clear? And this divided by 1 plus 5.36%. This will give you the this will give you the present value factor at the end of the second year. Clear? So what is my value? This multiply by this and this multiply by this. So my total payment is coming out at 1 crore rupees. So 99, let's make it the third installment, let's make it at 4, right? So this is 1 crore, right? 10 million, which is, and what is my closing, what is my present value? My present value is 94,99,895. I can round it off in the let's say to the nearest thousands, and it will become your 95 lakh. Okay, it will become your 95 lakh. So it is 95 lakh. 1, 2, 3, 4, right? So 95 lakh is my cash price equivalent. What is my cash price equivalent? My cash price equivalent is 95. Clear? My cash price equivalent is 95 lakh. Now I need to calculate the interest component as well, right? First step was calculation of cash price equivalent. The second step was calculation of interest component. Calculation of interest component. And let me tell you, the asset has to be recognized at cash price equivalent, 95, right? Now, how to calculate the cash price equivalent? First of all, at the beginning of the year. So at the beginning of the year, so let's put these all 3 dates, or let's say put this in the same manner, right? What was my opening balance at the beginning of the year? What is my opening balance? Of course, my opening balance at the beginning of the year is 95 lakh. But, and what is my interest? Okay. And then my total payment at the beginning of the year. My total payment at the beginning of year. Payment at beginning, right? My payment at beginning of the year, right? Then my principal amount in the installment. What is my principal amount? Payment of principal amount, and the remaining is my closing balance. Then my closing balance. So friends, if I talk about my, on 1st April 2001, I am purchasing this asset. So my balance was 95 lakh, and for 1 day there will not be any interest. No interest will be there. What is my payment at the beginning? My payment at beginning will be, how much? 33, 33, 333. My payment at beginning will be 33, 33, 333, right? This is my payment. And of course, this entire payment is my principal amount. There is no interest. So I'm just buying the asset today and I'm paying 33, 33. So there is no interest, guys. There is no interest, right? So the entire amount is my principal amount. What is my closing balance? 95 lakh plus interest minus principal. 61, 66, 667, right? So I am only talking about 1st April. But when I reach on 31st March 2002, what is my opening balance? My opening balance is 61, 66, 667. At the end of the 1st April, on 1st April, my balance was 61, 66, 667, right? So this is my opening balance for 31st March 2002. The opening balance was 61, 66, 67. And on this 61, 66, 667, I have to pay an interest of 5.36% per annum. Have you understood this? So the cash price is 95 lakh. On the day one, I'm paying 33, 33, 333. So on the day one, how much installment is outstanding? 2 installments are outstanding. How much money is outstanding? 61, 66, 667 is outstanding. So I have to pay interest for the 2 years on this amount. I have to pay interest for the next 2 installments for the next 2 years, right? So in this case, 533 is my interest. What is my total payment? Total payment is 33, 33, 333. What is the principal payment? The principal payment is this minus this, right? So principal payment is only 30 lakh. Only 30 lakh. So what is my closing balance? My closing balance will be this minus this. Or you can say that my closing balance is this plus interest minus total payment. right? So 3163,867. On 31st March 2003, this will become your opening balance. You have to pay interest of 5.36% on this, interest of 5.36% on this, right? And then your last installment will be this one, and your principal payment is only this amount, which is nothing, which is 3333 minus 169,583, and your closing balance will be this plus interest minus installment, which is your 116 rupees. Why this 116 rupees is coming? This 116 rupees is coming because what I have done, because I have rounded off this to 95 lakh. If I'll take the exact amount, this will not come, right? So let's adjust this particular thing into your interest portion, for example. So this is, let's say, minus 116, right? 116.64. So you can do that, right? Is it clear? Is it clear to all of you? Is it clear to all of you, friends? Now, what will be the accounting entry? Let's put the accounting entry now. On 1st April 2001, what is the accounting entry? Tell me, what is the accounting entry? Property, plant and equipment account debit. Account debit. By how much amount? By 95 lakh. Right. 2. Bank account. So bank account needs to be credited by how much amount? So bank account needs to be credited by 33. The first installment. 2. What is the second one? 2. Creditors account, because 2 creditors account, right? 2 accounts payable, right? I have to pay now. I have to pay for the next 2 installments. So what is the difference? This minus this, right? Which is this amount, 61, 66, 667, right? Now on the next date, which is 31st March 2002, what is the accounting entry? The accounting entry will be interest expense account debit. Interest expense debit by how much amount? Interest expense debit by 330, right? Interest expense account debit. Then you need to pay. Then you need to debit or creditor. Creditors account debit by how much amount? So by your principal amount. To bank account. To bank account. And what is my bank account? Of course, either you can add these two or you can just take this from the second installment amount, right? The third one, third accounting entry, 31st March 2003. What is my accounting entry? Again, I need to recognize interest expense debit. How much amount? 164,967, 169,467, sorry. Creditors account will be debited by how much amount? Again, it is by 313,316,867, right? And then your bank account will be credited by how much amount? Bank account will be credited by these two amounts, which is nothing, 33, 33, 334, right? So I hope these accounting entries are also clear to all of you. I hope these accounting entries are clear to all of you guys. Friends, let me know if the accounting entry is clear to all of you. Is it clear to everyone, guys? Is it clear to everyone? Is it clear to everyone? Friends, is it clear to everyone? Yeah. I hope it is clear to everyone, friends. Great. So friends, today we talk about what is meant by property, plant and equipment. And we have covered so many concepts of property, plant and equipment today. So this concept is Ind AS 16 will be covered in the next 2 classes. So I mean to say today's class and the next 1 class. So this standard is coverage of 2 classes only. So the next class will be, of course, on 15th March when we complete this standard. So friends, till the time, I request all of you to please revise this concept, stay happy and healthy, and we'll meet in the next class to conclude or to complete this particular standard. Thank you so much.